Hey there. If you're feeling like a chunk of your income disappears every year to the tax office, you're not alone. But what if I told you that there are simple, legal ways to reduce your tax bill just by planning a little smarter? In this video, I'll share tax-effective strategies for individuals in Australia, including salary packaging, deductions, super contributions, and more. Let's dive in. Number 1. Maximise work-related deductions. Let's start with what you can claim. If you work from home, travel for work, buy tools, or upskill, you might be eligible to claim deductions. Internet and phone, work-related portion. Home office equipment, work-related travel. Uniforms and protective clothing. Training or self-education. Just make sure you keep receipts and records and that the expense is directly related to earning your income. And remember, don't overclaim or double dip. The ATO uses bots to detect and flag any suspicious claims. Number 2. Use salary packaging, if offered. Salary packaging, or salary sacrifice, is when you agree to receive part of your salary as non-cash benefits, like a car lease, also called a novated lease, extra super contributions, work laptops or phones. These are paid with pre-tax income, which reduces your taxable salary and saves you money. This can be a great option if your employer offers it, especially for people working in government, health, or education sectors. Ask your HR department if you're eligible. Number 3. Contribute more to super, concessional contributions. Adding to your super is not only a smart retirement strategy, but it can also give you a great tax break. You can contribute up to $30,000 per year, which is the concessional cap in 2026 financial year, taxed at just 15%. If you earn over $45,000, this is usually much lower than your marginal tax rate. Here's a bonus tip. If you haven't maxed out previous year's caps, you may be able to catch up using unused limits from the past 5 years. Number 4. Claim investment-related expenses. If you invest in shares, ETFs, or property, you may be able to claim deductions for interest on investment loans, management or platform fees, accounting advice for investments, subscriptions to financial publications. Out of all these, interest could be the biggest. You can legally claim it as deductions if you have borrowed funds to purchase the investments. Again, keep clear records and make sure the expense is linked to your investment income. Number 5. Use the CGT discount. If you hold shares, crypto, or property for over 12 months, you may be eligible for a 50% capital gains tax discount. So if you made $20,000 in gains, only $10,000 is added to your taxable income. Timing matters, so before selling, check how long you've held the asset. Number 6. Take advantage of the Medicare Levy Surcharge threshold. If you earn over $101,000 as a single or $202,000 as a couple and don't have private hospital cover, you may pay the Medicare Levy Surcharge from 1% up to 1.5%. Taking out an appropriate private hospital policy may cost less than the surcharge and give you more flexibility with your healthcare. Also, don't forget, if you don't have hospital cover by 1st July following your 31st birthday and choose to take it out later in life, a lifetime health cover loading of 2% will be added to your hospital cover premium for each year you are aged over 30 without it. This is definitely worth checking if you're close to the threshold. Number 7. Donate to registered charities. Donations over $2 to an DGR are tax deductible. A DGR is an organization or fund that registers to receive tax-deductible gifts or donations. But not all charities are DGR, so make sure to check and keep the receipt of donation to claim. Number 8. Prepay eligible expenses before June 30th. Some expenses can be claimed in the financial year you pay them. If you're self-employed or a sole trader, you might be able to prepay interest on loans, subscriptions, or insurance to bring forward deductions. This can be useful if you had a higher income year and want to reduce this year's tax. That's a wrap on the tax strategies for individuals for 2026. With a bit of forward thinking, you can legally reduce your tax, boost your super, and grow your wealth. If this video helped you, give it a like and hit subscribe. Leave a comment if you'd like me to go deeper on any part. Thanks for watching.